18 months ago, I launched my own version of SCHD. The goal was simple. I liked SCHD, but I didn't necessarily like all of the stocks held by this fund. So the natural thing to do was to simply create my own ETF-like portfolio made up of stocks that better suited my investment style. Thus far, this process has worked out quite well. Over the last 18 months, my portfolio has beaten SCHD by 28.31%. SCHD's total return since November of 2022 is 9.97%, whereas my portfolio is up 38.29%. Surprisingly, this portfolio has also managed to outperform the S&P 500 by 5.03%. Let me tell you exactly how this strategy works, why I believe it has worked out so well, and where I think it can go in the future. Much like SCHD, my strategy is based on a few simple rules that help me identify the best stocks to invest in at a specific point in time. This rules-based approach removes any bias from the decision-making process and significantly simplifies the construction of an ETF-like portfolio. Essentially, I'm not trying to find the best stocks individually myself. Instead, I leverage a few data points to do the hard work for me. The objective is simple. I want to find high-quality dividend stocks that are reasonably valued and have a history of above-average growth. Once the screening process finds these stocks, I invest in them for a period of 1 year, and then I repeat the same process over again. Nice and simple. So why does this strategy work, and why has it worked out so well? In my opinion, the primary reason driving the success has been the focus on investing in high-quality stocks. We all know that investing in great businesses leads to achieving great results. All of the well-known investors talk about this as the leading reason for their success. Find great businesses, buy them at a reasonable price, and excellent results will follow. The difficult part in this is how do we find these great businesses, and how do we figure out if they are reasonably valued? Additionally, the average investor doesn't necessarily have the time to review 10 to 20 stocks each day to find these potentially great deals. These two hurdles are quite hard to overcome, and that is why it is recommended that the majority of people simply invest in ETFs and index funds, because it's far safer and will likely lead to achieving better results opposed to selecting individual stocks yourself. I believe that leveraging data can greatly simplify these hurdles and can be extremely beneficial to investors that want to select their own individual stocks. Let me tell you exactly how my strategy works, and you can decide for yourself if you think it makes sense or not. And feel free to borrow any part of my methodology if you think it can be useful in your own investing strategy. The strategy is simple and made up of 2 parts. Part 1 is coming up with a tailored, investable universe, ideally made up of high-quality stocks. Part 2 is taking this tailored shortlist of stocks and finding the handful that are potentially the most opportune right now. Let's go over Part 1 first. I use Schwab's stock screener to come up with this investable universe of stocks. The goal is to find companies that have a good history of growth, are run by a competent management team, have some type of competitive advantage, and lastly, companies that have safe and growing dividend streams. To identify these companies, I use 8 screening criteria. Number 1 and 2 are a 5-year revenue and earnings per share growth rate of at least 5%. This fills the history of growth in my objective. Number 3 and 4 are an exemplary or standard stewardship rating and a wide or narrow moat rating for Morningstar. This addresses the management team and competitive advantage in my objective. Number 5, 6, and 7 are a 3 and 5 year dividend growth rate of at least 5% and a payout ratio of 80% or less. This takes care of the dividend safety and growth for my objective. The 8th screening point I use is that these companies must trade on the New York Stock Exchange or the Nasdaq, because I'd like to easily be able to invest in the ideas this list produces. I don't want to find a foreign stock that may not be available to me as a US investor. When I run this screening process, it typically gives me a short list of about 100 unique stocks. Next, I move on to part number 2, narrowing this short list down to just the top 20 stocks. I do this by using 4 financial metrics to rank all of the stocks found by the screening process. These financial metrics are the free cash flow to total debt ratio, the 5-year dividend growth rate, the return on capital, and the forward dividend yield. Once I rank all of the stocks, the process is complete, and I have my list of the top 20 stocks for inclusion in my portfolio. This process is by no means perfect. Not all of the top-ranked stocks will go on to yield excellent results. But on average, in my limited test period, the top-ranked stocks have delivered returns that are more favorable than the entire shortlist of stocks. And these returns are competitive against the broad market and SCHD. My actual portfolio, where I deploy this strategy, is currently made up of 25 stocks. The reason I have 5 more stocks in my portfolio versus what I stated earlier is because I'm constantly optimizing the strategy. And 6 months ago, when I ran this process, my strategy was to invest in the top 25 stocks. Since then, based on return patterns I've observed, I've made a change to make the strategy more concentrated. And next time I run this process, I will only select the top 20 stocks. This strategy is currently in its fiscal year 2. The reason I use fiscal years is because I originally launched this strategy in November, so it doesn't run neatly on calendar years. The fiscal years run from November 1st to October 31st. Fiscal year 1 was a little different than fiscal year 2. In year 1, the portfolio was made up of 30 stocks and had a complex format to set the weight of each stock. Based on observations during that year, I made a decision to simplify the strategy for year 2 by trimming the number of stocks to 25 and giving them each an equal weight of 4%. This portfolio finished year 1 with a return of 10.9%, which was 15.41% better than SCHD and 0.75% better than the S&P 500. In SCHD's defense, the ETF really struggled in 2023, and the margin of outperformance my strategy delivered was probably much higher than what I expect going forward. The end of April marked the halfway point for fiscal year number 2. My portfolio's return for this 6-month period is 24.7%, which is 9.53% better than SCHD and 3.71% better than the S&P 500. The strategy is on pace to deliver better returns in fiscal year 2, but there are still 6 months to go and things can quickly change. The cumulative return for the full 18-month period since this portfolio was launched is 38.29%, which is 28.31% better than SCHD and 5.03% better than the S&P 500. This gives my strategy a 24.12% compounded annual growth rate. My personal goal for this strategy is a 12% CAGR. For now it's doing better than expected, but I won't be surprised if the long-term CAGR declines from its current level. If you want to know which 25 stocks are included in this portfolio, I'll leave a link in the description below to the video that I made in November when the portfolio was rebalanced. Now, the one area where SCHD still outshines my strategy is in the dividend income department. SCHD yields about 3.7%, whereas my portfolio only has a dividend yield of about 2.25%. That's a pretty large difference. But I believe in due time, if my strategy continues to work as expected, it can not only produce the same amount of dividend income as SCHD, it has the potential to exceed SCHD's dividend income, all the while giving me a much higher market value. Mind you, this test portfolio is quite small. I started this portfolio with $1,812.75. Currently, it has a market value right around $2,500. I've put more money to work using the strategy, but since this was the original pilot portfolio, it is the perfect tool to evaluate how the strategy is working. So I won't be adding any more money into this account, and its main purpose now is to properly evaluate the strategy. Alright, let's take a look at the actual dividend income and how it compares to SCHD. Here I have the dividend income broken down by quarter, and I've gone ahead and calculated how much dividend income I would have received had I invested the original $1,812.75 into SCHD on November 1st, 2022. You can see that the first quarter, quarter 4 of 2022, SCHD paid out nearly 70% more dividend income. This is a little skewed, as my portfolio was launched on November 1st. It not only missed the whole month of the quarter, I also missed a bunch of ex-dividend dates for quarter 4. For the first 3 quarters of 2023, my portfolio generated about 30% less dividend income relative to SCHD. In quarter 4 of 2023, the portfolio received more dividend income as a result of the rebalancing. It just so happens that I was able to capture a few additional dividends when the rebalancing took place. And also, the newly selected stocks paid a slightly higher average dividend yield compared to the stocks that fell out of the portfolio. Quarter 1 of 2024 is a better baseline for comparison to SCHD. And as you can see, my portfolio is now generating only 20% less dividend income than SCHD. While SCHD still pays more dividends than my portfolio, the trend is moving in my favor, and in due time, this gap to SCHD will shrink entirely. Comparing dividend income based on fiscal years is probably the most ideal way to evaluate the shortfall of my portfolio. In fiscal year 1, my portfolio was about 36% lower than SCHD. And in fiscal year 2, at the moment, my portfolio is about 18% below SCHD. If this trend holds out for the remainder of the year, it would mean that I would cut the margin of difference to SCHD in half in fiscal year 2. Perhaps another 1 or 2 good years, and my portfolio will come close to breaking even with SCHD. In June of 2023, I started tracking the 4-factor strategy every month to see how well the strategy would perform if it ran on a different fiscal cycle. We are very close to having the first list complete its full 12-month cycle, and I can report that it is beating SCHD by a double-digit margin, and sitting comfortably ahead of the S&P 500 as well. I share this data with my Patreon community, and they see the newly published 4-factor list at the end of each month. I have also recently published another data-based investing strategy in my newsletter. There's a link in the description below if you'd like to check it out. I hope you enjoyed the video. If you did, please do me a favor and give it a like and subscribe to the channel. Thank you for watching and see you next time.